Hello and welcome to the Corrigan Krause construction presentation on the impact of the new lease accounting standard, specifically related to construction companies. I'm Dennis Dlugosz. I'm a director at Corrigan Krause and also the director in charge of our construction services division. Our goal today is to just make sure we discuss the significant items that are going to happen with the new lease standard and how they're going to affect our financial statements for our bonding agents and third parties, and also how you, the client, or you, the advisor to the client, can help your clients navigate what is needed. The most important thing, and I think as we'll discuss in the future, is just to make sure, in anything that we do, we want a consistent level playing field, making sure that our clients and other clients that are in the same industry that are competing against each other are utilizing the same accounting standards, which is why we have accounting standards. So our team today is made up of our Corrigan Krause Lease team, which is Tommy Sustar, Alexis Burch, and Molly Stinn. Again, we thank you for joining us and taking time out of your busy day. I know that we're all trying to fit in as much as we can before the holidays, and we appreciate everybody signing on and learning a little bit from our team. All right, Tommy.
Thanks, Dennis. Hi, my name is Tommy Sustar. I'm a senior manager in our assurance services department. I recently took over as the ASD department head for the company. I've been with Corrigan Krause for about 2 years now. Prior to that, I worked at Ernst & Young for 11 years and BDO for 3 years. Done a lot of work with COVID consulting in the past year. I also helped to lead our manufacturing and our audit niche group. And I will let Alexis go next.
Hi, good morning, everyone. My name is Alexis Burch. I'm a manager at Corrigan Krause. I've been with the firm a little over a year now. Prior to my experience with Corrigan Krause, I was at Deloitte for 6 years in their audit practice. So my specialty here at Corrigan Krause is still working with audit clients, but also have expanded to do reviews and compilations.
Hi, I'm Molly Stinn. I am a director in Corrigan Krause's Assurance Services Department. I've been here since 1994, so I've been involved with all aspects of the assurance department, including recently handing over the reins to Tommy. Tommy, Alexis, and I are members of Corrigan Krause's lease team, as is Sherry Terrence, who unfortunately was unable to join us today. We really want to thank all of you for joining us. And we just want to remind everybody that we want today's event to be interactive. So please use the chat or Q&A function to post any questions or comments you may have. We're also recording today's webinar, and we'll send it out to you along with the accompanying presentation once we wrap up today's webinar. Be sure to email info@corrigankrause.com to be added to our construction services email list. I know there's a lot of good information that niche sends out throughout the year, and it's a really good source of information to be keyed into the accounting part of the whole industry. So let's start with a brief overview of the new lease standard. Alexis is going to run this through for us.
Yes, so FASB, the Financial Accounting Standards Board, introduced the new lease standard about 6 years ago. There were some delays such as COVID. So finally, the lease standard will go into effect for private companies for 2022. The standard will not have an impact on earnings or cash flows, but this is going to require a lot of companies to be putting leases on their balance sheet. Which, that being said, so construction companies who have equipment, vehicle, facility leases, they will be seeing an increase in their liabilities as well as an increase in something called a right of use asset related to these leases. The liability will reflect the present value of the remaining lease payments required using a discount rate over the term of leases. And then the right of use asset is generally offsets that lease liability that is recorded. Under the old standard, there was only a lease liability related to a lease liability and a related asset for capital leases. But with this new standard, it will not only impact capital leases, but it will have the most impact on operating leases for these companies.
So you're saying that in the past and up until the effective date of the new lease standard, a construction company's operating leases for its business office and other facilities and its leased equipment and leased vehicles were all held off balance sheet, but just disclosed within the financial statements. But now they're going to all be on the balance sheet. And you also said there was going to be a right of use asset that would generally offset the lease liability. So I guess my question is, with this offset, why is there a concern about the new financial reporting?
So really, with the new lease standards, a very small chance that it will have no impact on your loans or your bonding. In all likelihood, if your loan covenants were kept as is, there would be some sort of negative impact as a result of the adoption of the lease standard. So now we're going to run through a few different ratios to help you understand the impact that sort of the before and after of the lease standard will have in these ratios. The first is your debt to equity ratio. And let's assume that your loan requires a debt to equity ratio of 1.25 to 1. Now, while the FASB may consider the treatment of your operating leases, or may not consider operating leases as debt obligations, your bank most likely is going to see things a little bit differently. For example, if we look here, we have assets of $500,000, liabilities of $250,000. So your net worth is $250,000 under current accounting for leases. So your debt to equity ratio is 1 to 1. So based on this, we would be passing our loan covenant. Now let's assume that we have added to the balance sheet a right of use asset of $250,000 and then a liability, which is the present value of the future payments of also $250,000. This has quickly changed your debt to equity ratio to 2 to 1, and you wouldn't be in compliance anymore with your debt covenant. So it shows that although you're adding a similar amount to both the balance sheet and your liabilities, or sorry, your assets and your liabilities, it could cause you to negatively affect your loan covenant.
Okay, so I see that negative impact now, even though there is a right of use asset offset on the balance sheet itself, there is no impact on the way that will affect, or there's a negative impact on the way that offset on the balance sheet is going to affect the ratios that we're calculating. So what other negative impacts and other ratios and metrics should we be looking at?
So there are a few other leverage ratios we're going to go through, which could help to determine the level of debt the business has incurred. We're going to look first here at the total debt ratio. So this is total debt divided by total assets. And you can see here what under the existing accounting for leases, your ratio is at 0.5. And then when we add the $250,000 to both the assets and the liabilities, our total debt ratio increases negatively to 0.67 and could potentially affect your compliance with this ratio. The next here is your asset to equity ratio. And this helps to analyze the impact adopting the lease standard would have on this ratio as well. So again, here, when you're adding the right of use asset and the liabilities to your balance sheet, you can see that we've increased the asset to equity ratio from 2 to 3.0. It's possible sometimes with this ratio that certain non-financial assets such as property and equipment could be excluded, but for purposes of this example, we've shown the increase from 2.0 to 3.0 negatively affecting your ratio. The next one here is your debt to capital ratio, and this is calculated with total debt divided by total debt plus total equity. And this again is increasing your debt to capital ratio from 0.5 to 0.67, which is having a negative impact on the ratio for compliance with your loan covenants or ratios as a result of this new lease standard.
Okay, and see here that we have put together a summary for all the leverage ratio and the impact that the new standards have on these various leverage ratios. So you can see that there's definitely a negative impact on the debt to equity, total debt, and debt to capital ratios. And you know, the asset to equity ratio is potentially going to be neutral, but there can be some negative aspects to that as well. These are the leverage ratios, but let's take a look at what kind of impact there's going to be, or we expect to have, on the liquidity ratios. So here's a slide that shows those liquidity ratios and metrics that are used to evaluate a company's relative ability to pay off its short-term obligations. These will also be negatively impacted by the new lease standard, specifically because each of these metrics is calculated relative to current liabilities. And current liabilities, as we've said throughout this presentation, are expected to increase as lease liabilities are recorded and classified based on payment terms. So the current ratio is calculated as current assets divided by current liabilities. The new lease standards should have zero impact on current assets, as we've sort of stated before, because the right of use assets are typically going to be long-term. But the current liabilities we expect to increase. So the current ratio will decrease, and that's a negative impact. The cash liquidity ratio is calculated as cash and cash equivalents divided by current liabilities. As the new lease standards will have zero impact on cash, this ratio will also decrease and cause a negative impact due to the expected increase in current liabilities. The quick ratio is the sum of cash and cash equivalents plus marketable securities plus accounts receivable divided by current liabilities. Again, the new lease standard will have zero impact on cash, marketable securities, or AR, but will definitely increase current liabilities. So the quick ratio would decrease and also have a negative impact. Alexis, what do we expect the impact to be on profitability, earnings per share, and cash flow ratios?
The new standard will not leave any impact on revenue, operating income, or net income. This standard is really only a classification change with expenses and mostly impacted by operating leases. Since there is no change in the earnings due to this standard, EPS should not be impacted by this implementation. The new standard capital leases will now be called finance leases, but the accounting around these leases is going to be very similar to as it was under the old standard with capital leases. So the companies will be recording amortization expense against the right of use asset that's recorded on the balance sheet, and then interest expense related to the interest portion of the liability. For operating leases, you would think it would still amortization interest expense, but for this case, companies will be recording a lease expense as a single line on their income statement for that amortization and interest expense against the asset and liability. Because of this, there will be an impact to earnings before interest and tax, because you won't be able to add back the interest expense that is normally being recorded for the finance leases. So a way for companies to avoid this issue or to avoid the impact on that is to structure their leases as finance leases instead of operating. As for the cash flow, there will be little change because of the standard. The principal payments for finance leases will still be financing activities on the cash flow statement. The interest paid will be operating cash flows. And then in regards to operating leases, that lease expense we mentioned that's being recorded on the income statement is typically an operating cash flow. The biggest issue that is going to come into play with this is in regards to the debt coverage ratio and the return on assets ratio, or cash return on assets ratio. A lot of covenants include a debt service coverage ratio, which is EBITDA divided by the debt service requirements. And because companies will need to be adding these liabilities onto their balance sheet in the current section, their current liabilities will increase, therefore decreasing this ratio as an impact to that. And in regards to the cash return on assets, So net income divided by an average total assets. Companies will be adding these right of use assets onto their balance sheet, therefore increasing their total assets and then causing a decrease to that return on asset ratio.
So it's obvious now to me that there is this impact by the new lease standards on all of these calculated ratios and metrics and other analysis, and that impact is going to be significant. But I understand that there are also other areas beyond just these metrics that we'll need to be aware of when considering the impact on construction financial statements in particular. Tommy, what are those areas?
Sure. So another thing that we want to remind bonding agents, sureties, and construction companies about are embedded or hidden leases. So accounting literature related to the new lease standard asks for us to be aware of the potential for there to be lease agreements to have embedded or hidden leases in their service agreements. A hidden lease is a portion of a contract that does not appear to be a lease, but under the new lease standard is classified as a lease now. Hidden leases are typically found in a contract between a company and a service provider and refer to the control of an asset that we use to provide the service to that company. So for example, if a construction company has a service provider to deliver materials to a construction site for them, and if in that service contract they have specified the type of trucks or what trucks must be used to deliver the materials to that construction site, you actually have a hidden lease in that agreement. So many standard contracts may now contain hidden leases. If the company identifies this hidden lease within these service contracts, they would now be adding a right of use asset and a lease liability to the balance sheet that was not previously disclosed in the financial statements.
Thanks, Tommy. And I guess my biggest takeaway on all of this is that, whether you're talking about hidden leases that are embedded into service contracts that a construction company has been involved with for many reporting periods, or if we're talking just about the entire conversion to the new lease standards, including putting those now assets and liabilities from operating leases onto the balance sheet where they haven't been before, we're not really talking about anything that changes that construction company's operations. They're still using the same service contracts that they've used before. They are still subject to the same operating leases that they've been subject to before. They're now just complying with these new accounting rules and regulations, the purpose of which is to show or to communicate that construction company's financial position a little bit better. But I guess there would be a tendency to think that since there's such a shift in all these ratios, that the construction company itself has changed something about how they're operating, and that the fallout is this negativity in the ratios. And I think it's important for us all to remember that the operations of the company aren't changing at all. It's just these accounting rules that are making a big shift in the way that we used to analyze all these companies. So maybe the thing that we need to think about is there a different way that we're going to look at analyzing these companies, measuring their compliance with various covenants, et cetera. And that's not something that's written into GAAP. That's something that, each individual company is going to have to work out with their bonding agents, et cetera, to make sure that there's some clarity in what is actually going on with those individual companies. So that's something that I see, and I think that we all really sort of have to think about in terms of how we're going to take this conversion in GAAP and make it real in the lives of our bonding industry and also within the construction industry itself. It's not just the debits and credits that are specified within this new GAAP. So I think also that there's probably some impact that the effective date itself may have on the statements. And Tommy, I think you have something that you want to go over with us regarding that.
Sure. So the timing of the effective date or adoption of this new standard also poses some challenges for companies. So if you are a calendar year private company, you will be required to adopt this after the year end 12/15/21. So for your 12/31/22 financial statements, you would be required to adopt this from a year end perspective. The issue or potential challenge here is that this must be adopted retrospectively. So as of January 1st, 2022, you would need to formally adopt this lease standard and have the right of use asset, lease liabilities, and incorporate those changes. In general, for a year-end reporting 12/31/22, this may not be as much of a challenge for you, but if you are a company that has interim reporting with either the bank or a bonding agent or some other type of company, you're required to report interim financial statements on a GAAP basis, you may be required to adopt this quicker and have to report your interim financial statements using this starting with January of 2022. So what we would recommend here is it's important to communicate with either the bank or the bonding agent you have if that's going to be a requirement that will start to be necessary starting here in January of 2022, which is fast approaching here. So really the biggest message is start your communication with those companies and make sure of what will be required and how you need to incorporate that in your GAAP financial statements.
Thanks, Tommy. I know that we've gone over, a lot of things that a lot of details, a lot of data, a lot of number crunching kinds of things, but I guess I wanted to go over back to a few of the concepts that we introduced and maybe give some, better real examples. So I know Tommy gave us one example of where there would be a hidden lease in a construction contractor's service contract, potentially with, a vendor for raw materials. But Dennis, do you have any other examples where we might see something like that that's already existing in a construction company's daily operations that is going to impact us in terms of a hidden lease?
No, I think for the most part, what Tommy said for the materials, but also the delivery, utilizing those specific trucks, like Tommy said, for delivery. I can't really think of anything off the top of my head that would be a hidden lease. Maybe that's why they call it hidden, because you're not supposed to find it. Tommy, is that what is true to that?
I think the biggest exercise with this is going through your service agreements that you have with companies, because I think there could be examples of service agreements you have where you don't realize there's a certain specification of, in this example was the trucks, but there could be other things that are specified. They can't be substituted. You need to think of it as something that can't be substituted for your specific service agreement that could trigger this being a potential lease. And so looking at those service agreements and seeing if there are very specific items that you're requiring this that can't be substituted by the service provider.
Okay, so we've identified these the impacts on the metrics, the leverage ratios, liquidity ratios, debt service coverage ratio, which is really going to be a big one, I believe, with our construction clients, and cash return on assets. We talked about the potential for hidden leases and the requirement for the retrospective application, meaning going back to the beginning of the year of adoption, which would be 1/1/2022 for most of our clients, and considering the financial reporting on those interim reports. But what are some of the key ways, Dennis, that you could see that maybe we can sort of mitigate some of these negatives in working with our relationships with our bonding agents and other third parties?
Thanks, Molly. And thanks everyone for going over the information. Some of the way that we can mitigate this now is making sure that we're getting out in front of our clients and also discussing with our bonding agents and bankers. The big thing that we talked about before was just making sure that we have a level playing field, making sure that the implementation is consistent across the board and what the banks and the bonding companies are willing to accept is also consistent. We want to make sure that we do not do anything that inhibits the ability to get bonding, the ability to pass your bank covenants. And the biggest thing is communication with that. The other ways is that, you see this word legacy gap there. Some of the bonding and bank companies have said that they'll continue using legacy gap, which means legacy gap kind of means it's not current gap. I guess that's what that would mean, and be willing to accept that. The issue with that is how long does that last, and when it does legacy gap turn into a true legacy, meaning that you're not going to be able to use that. What we've done at Corrigan Krause is that we've invested in infrastructure to help our clients calculate and keep track of these leases, because we believe that legacy gap will soon disappear and it will be acceptable for all of our clients to be underneath these new lease agreements. And the third thing is just communication, like we talked about before, is talking to your bonding companies, talking to the bankers. How are you guys going to measure this impact? Are you guys changing ratios? Are you guys looking at this differently? Are you willing to accept a different form of a financial statement in this interim period? And lastly is to internally communicate as necessary. I think when you look at this and you look at the people that we have on this, is that they're all in the leadership positions of their companies. It's making sure that, the AP clerk or the people entering into these agreements know what they're getting into, and making sure that the CFO, the controller, are actually reviewing the documents, and maybe even involving your accounting team to make sure that they're structured correctly to not have such a negative impact on your financial statements. Because when we look at it in the construction world, working capital is decreasing. We never like when working capital decreases. And I know the bonding agents don't like when working capital decreases. Debt to equity decreases, all right? Or increases. We don't want, we don't like that either when debt to equity increases, because we want to keep that underneath a certain level. The one question I have on this one, maybe for the team, is we always talk about the big M word in whatever we do, is materiality, and making sure that we understand materiality and how we would kind of affect that with our financial statements. And whoever of the team can discuss materiality, that would be great.
Sure, I can do that. So, kind of similar, I guess, to correlate it to, sometimes companies have fixed asset policies of what they actually capitalize. We would look at this as certain leases under a certain thresholds, depending on the size of the company, would be immaterial for this, and you wouldn't have to really assess as much. So if you had a printer in the company or a copier that was very immaterial to your financial statement, those might be things that you wouldn't have to go through the formal evaluation of this process. And as you're going through evaluating all your leases, you want to make sort of an election with CK here of what you're considering for that to be immaterial leases. But those are a couple examples of things that probably aren't high dollar amount that may not need to go through this process.
Alexis, can you probably discuss like what can a company do today to make sure that they're prepared? And are you able to, take this new ASU into account even when you're not required to, maybe for this year end?
Mm-hmm. Yeah, I think the best advice is to start talking to your CPA firms and say, what can I do now? A big part of this is just collecting all your lease documentations or your contracts and start looking through. I mean, I know for the clients that we're trying to early implement, that's what we're working on now. Just make sure we even have everything so we can look through these contracts and leases. And then when the time comes and we're ready to implement, we'll start putting that information into the lease software we'll be using. So every CPA firm is tackling it differently. As we said, this doesn't go into effect until 2022. So companies still have time, but depending on the extent and number of leases you have, the sooner you start thinking about what kind of impact and what you need to do ahead of time, the better.
Awesome.
I think the other thing that we really want to make sure that all the participants know, and various third parties know, is that we at Corrigan Krause are being really proactive in this. We have, the three of us, Alexis, Tommy, and I, along with Sherry, leading up our lease team. But that doesn't mean it's just the four of us. We've taken great strides to really train and inform all of our assurance staff on what this means. We're reaching out to each one of our clients to make sure they understand that they know what that means. We've invested in software that will ease the burden of calculating the impact on the financial statements themselves. And that's something that we are starting very early on. We've identified several clients to be early adopters of the lease standards, but like Dennis had sort of alluded to and Alexis started to talk about, we can start right now, even if someone isn't going to early adopt, we can start to take a look at what is that balance sheet impact. What is going to be the impact on all of these different ratios, and get out early with our third-party users of financial statements so that they can start to see what this is going to look like once 2022 and the first report, the required reporting periods for each entity, come up in the calendar. So we really are trying to get out there ahead of this. I don't think we have any other questions. Is there anything else that our panel wants to bring up to make sure that everyone is aware of? Here
I would just say that, a lot of people will go into saying, all right, well, I'll just have a gap departure and keep doing it the old way. I think that when you do that, you can create an issue without creating an issue, because a lot of your financials will be required to be on GAAP. So you need to get the bank's approval, if it's loan, to have a gap departure and discuss that with them. So, if you're not, again, it comes down to communication. If you're planning to say, hey, I don't want to spend all this time to get my information underneath GAAP, and you're just going to do a gap departure, if you don't communicate that, you could set yourself up for an issue. Also, down the road, if you're going to compare yourself to other companies and basically benchmark your ratios, you're never going to be able to truly get a good feel if you don't take this into account, because the people that have a good CPA firm behind them, that have good internal accounting, are going to be doing this. So down the road, this could be an adjustment for your quality of earnings if you're looking to sell, and could create a less reliance on your financial statement.
Yeah. So, I mean, we're here to make sure that the financial reporting is clear, is consistent, it speaks the language that everyone out in the marketplace is expecting to hear. But we also want to be able to ease this transition with all of our financial statement users. So if there is nothing really else that we wanted to talk about today, we just want to make sure that you are all aware that we are available to clarify anything on this topic, or to assist in the specifics of any particular company in adopting these standards in the future. So I want to thank everyone for attending our webinar today. And as we mentioned at the start, please email info@corrigankrause.com to join our newsletter list, and check out corrigankrause.com/events to see Corrigan Krause's upcoming events and archive webinars and other webinars that will be coming up in the future. And just want to wish everyone a really great day today. Thanks for joining us.